Andrew Left is one of the most famous short sellers in the world. For well over a decade, he operated a website called Citron Research, where he released reports on stocks that he believed to be fraudulent or overvalued. He's perhaps best known as being one of the most high-profile short sellers who got burnt by the GameStop short squeeze of 2021. On June 26, 2024, Left was indicted on charges of securities fraud. Prosecutors accused him of abusing his influence to manipulate the prices of dozens of stocks, ultimately generating $16 million of ill-gotten trading profits at the expense of his followers. If convicted, Left could serve a maximum of 25 years in federal prison. In this video, we'll look at how Andrew Left became one of the world's most famous short sellers, his alleged securities fraud, and what this means for the practice of short selling going forward. Andrew Left got his start in the world of investing in 1993 when he graduated from college and got a job working for a company called the Universal Commodity Corp, or UCC. UCC sold commodities contracts to retail investors. Left worked as a telemarketer, cold calling retail investors trying to sell them questionable investment products. If you've ever seen the movie Wolf of Wall Street, that's basically the kind of place that UCC was. To be fair to Left, he only worked at this job for 9 months before quitting. He saw that the company was basically scamming its customers and didn't want any part of it. The experience at UCC gave Left an inside look at the shadier side of the financial industry. Unsophisticated investors were regularly duped into buying penny stocks or other dubious investments, which often resulted in huge financial losses. Given that many penny stocks are pumped up to inflated valuations by unscrupulous promoters, Left saw an opportunity to make profits by selling short these stocks. In the late 1990s, he started short selling stocks as a full-time job. In 2001, he started a website called stocklemon.com and eventually changed its name to Citron Research. Here he would publish research reports about the stocks he sold short, often accusing them of being fraudulent or overvalued. Andrew Left is the sole owner of Citron Research, and Citron never managed outside capital. Left only managed his own money. So for the remainder of this video, we'll talk about Andrew Left and Citron Research interchangeably. On the surface, this looked like a win-win situation. When Andrew Left identifies a fraudulent company, he sells the stock short and alerts the public to the alleged fraud. This information can prompt existing shareholders to sell their shares, driving the stock price down and benefiting Left's position. While original investors may suffer short-term losses due to the declining share value, these losses are inevitable if the company is indeed fraudulent. Exposure by Citron Research can hinder the company's ability to issue new shares. Therefore, when an activist short seller like Andrew Left successfully uncovers fraud, it benefits the investing public and represents an ethical way of making money. Throughout the early 2000s, Andrew Left built an impressive track record. Many of the companies that he released short reports about were subsequently charged with fraud by the SEC, thereby vindicating Left's short theses. Andrew Left really made a name for himself in October of 2015 when he released a short report about a pharmaceutical company called Valeant. He accused the company of fraud and compared it to Enron. Left's allegations against the company ended up being true, and the share price subsequently collapsed. A high-ranking executive at Valeant was eventually convicted of fraud, further vindicating Citron's short report. Prior to Andrew Left exposing the company, Valeant had a market capitalization in excess of $70 billion, and its stock was well loved by Wall Street. By exposing Valeant, Andrew Left gained a reputation as a shrewd investor who could sniff out fraud that would otherwise have flown under the radar. Having cemented himself as one of the most successful activist short sellers, Left was often invited to financial news channels such as CNBC and Bloomberg. This exposure allowed Citron to garner hundreds of thousands of followers on social media. Whenever Citron released a short-selling report, many investors would react by selling shares in the company. Investors who already owned shares would close their positions. Other short sellers would also sell the stock, hoping to benefit if the share price continues to fall. This would often cause a significant decline in the share price on the day the short report was released. Historically, Citron was best known for its short-selling research, but they occasionally also release favorable research reports on stocks they are long. So why might a short seller want to publish his ideas to the public? All of Citron's research reports were available for anyone to view free of charge. What benefit does Andrew Left gain by giving away all of his ideas for free? Let's say hypothetically that a company is fraudulent or overvalued. Its stock currently trades for $100 per share, but the fair value is only $50. Eventually, the company will start missing earnings expectations, or its fraud will collapse under its own weight. Eventually, the share price will fall to the fair value of $50. For the sake of argument, let's say this takes 1 year to happen. As a short seller, you would make a 50% return shorting the stock. Now let's say you release a short report exposing the company as a fraud. Your short report catalyzes mass selling, and the stock immediately falls to its fair value of $50. You can cover your position and reinvest your profits into the next one. Let's say you release 5 short reports over the course of a year, and each time the stock falls by 50% immediately upon the release of the report. A 50% return compounded 5 times is 660%. But it can get even better. Instead of selling short shares of the target company, you can buy put options. Prior to releasing your short report, you purchase put options with a strike price of $75. You buy the put option the day before you release the short report, and it expires the next day. Under normal circumstances, it would be extremely unlikely that a stock would fall by 25% in one day. Because of this, the premium you need to pay to buy the option is very cheap. Let's say you can buy this put option for $2. After you release your short report, the stock price falls to $50. Your option yields a payout of $25. This is a more than 10 times gain on your investment. According to the DOJ and SEC, Andrew Left would both sell short and buy put options on the target companies prior to the release of his short reports. He would often begin closing his positions within minutes or hours of publishing the short report. Between March of 2018 and December of 2020, Citron Research released 26 reports or tweets targeting 23 individual stocks. On average, the share prices of the targeted companies would move by 12% on the first day of trading after the report was released. During this period, he allegedly generated at least $16 million of trading profits. These returns were far greater than what they would have been had Left just shorted the stocks quietly. Andrew Left profited handsomely from the ability of Citron Research to move stock prices. For this strategy to work, Left needed a large audience of followers who trusted his research and would buy or sell shares of the target company based on his recommendation. This is where the alleged fraud comes in. Prosecutors allege that Andrew Left deceived the public into trusting his research reports. Let's look at one of the examples of Andrew Left's alleged deception. In August of 2018, Left messaged one of his associates to talk about a short report he planned targeting the Cronos Group, a Canadian cannabis company listed on the NASDAQ under the ticker symbol CRON. Left said to his associate, quote, "We can destroy CRON, unquote, and quote, "Cron short we could get $2, unquote." This indicates that Left expected to make a profit of $2 per share. On August 29th, Andrew Left built a short position equivalent to approximately 884,000 shares of Cronos stock. This included selling short the stock, buying put options, and selling call options. The very next day, he published a tweet that linked to a short report titled Cronos, the dark side of the cannabis space. The report said that Cronos' stock price was overvalued and accused the company of misleading investors. At the time Left released the report, Cronos' stock price was $11.50 per share. In the report, Left gave a price target of $3.50, representing about 70% downside. After the tweet, Cronos' stock price started to freefall almost immediately. Andrew Left wasted little time in taking advantage of this. Within 24 minutes, Left had covered approximately 61% of his short position. He covered the position at prices far higher than his $3.50 price target. That same day, Left went on CNBC to talk about his short report.
Andrew, great to have you with us. So the stock is down 30%. I have to ask you this right off the bat. Are you still short Cronos right now, or did you cover?
Oh, I'm definitely still short the stock, no doubt.
Okay. So how does this play out? Because what you're alleging is pretty serious. I mean, you're basically saying that there could be securities fraud here.
Even if there's nothing wrong with the company, even if everything is fine with the company, then the stock's $3.50. If I want to give them the same multiple as all their peers, who I don't think have the same issues that they have, the stock's $3.50. So that's being generous to them. And that we're talking US here, okay? So why would I not be short the stock? It's a very competitive industry. I think they're a subpar player. I think they have a lot of issues with disclosure, with production, with the commercialization of their product. I think they've overpromised, and I think they're trading way out of whack with the rest of the industry.
All right, and last question, Andrew. You're short. You say you remain short. When did you put that short on, and will you take that short down to 350?
Oh, I don't. Come on, Melissa, you always ask that question, and it's irrelevant when I put it on or when I'm going to take it off. What's relevant is the information
here's what's
that's in the
relevant.
report.
Here's what's relevant to people watching. Are you just as short the stock right now as you were at the beginning of the day?
I took a small size of the position off today. Yes.
Okay.
But I'm still extremely short this stock. I believe the stock trades down to where it was just 3 weeks ago, $6.
Okay.
And then right down to 350. Yeah.
Andrew Left admitted that he took a small size position off that day, but remains extremely short the stock. When you juxtapose a small size position versus remaining extremely short the stock, a reasonable person would probably assume that Left kept the majority of his short position. In reality, Left had covered 61% of his short position at the time of giving this interview. Andrew Left allegedly made approximately $500,000 of trading profits from Kronos. In a private communication with one of his associates, he compared his trading profits to, quote, taking candy from a baby, unquote. On May 17, 2019, Andrew Left shorted approximately 500,000 shares of the fake meat company Beyond Meat. At the time, Beyond Meat's share price was approximately $88. He put out a tweet saying the company's valuation was beyond stupid, and he expected the share price to fall to $65. Within 13 minutes of releasing the tweet, Left had closed 98% of his position. A few minutes later, CNBC contacted Andrew Left asking for comments. He told CNBC that he indeed shorted shares of Beyond Meat that day. He failed to disclose the fact that by this point he had already closed nearly all of his position. We can see a pattern start to emerge. According to the prosecutors, Andrew Left repeatedly misled the public about his trading activities to make it appear that he had more skin in the game than he actually did. For most of its existence, Citron Research primarily focused on releasing short-selling reports. In early 2021, Andrew Left was short shares of the video game retailer GameStop. Left suffered significant losses during the GameStop short squeeze. He also drew the ire of many retail investors on the Wall Street Bets forum. Left's entire strategy was for the share price of the targeted company to decline whenever he released a short report. With the rise of the meme traders, they may actually buy shares of the target company in an attempt to catalyze a short squeeze. After suffering massive losses on GameStop in 2021, Andrew Left announced that Citron would no longer release short-selling reports. Going forward, they would only release long recommendations. According to prosecutors, Andrew Left also traded around the publication of his long recommendations. For example, on December 23, 2020, Andrew Left tweeted that he was long shares of XL Fleet, an electric drivetrain company that went public by merging with a SPAC. At the time of the tweet, XL Fleet's share price was about $25. Left touted XL Fleet's blue-chip customer base and said that the company had a total addressable market of $1 trillion. He set a price target of $60. XL Fleet ended up being a complete dumpster fire of a company. We made a video about them last year. Their core business completely failed, and they changed their name to Spruce Power Holdings. As of the time of recording this video, their share price is $3.39, or just 42 cents adjusting for reverse stock splits. Within days of Andrew Left's long recommendation, the stock peaked at about $30 and has been on a downward trajectory ever since. Anyone who followed Left's tweet, hoping for the $60 price target, would have suffered a near total loss. As for Andrew Left himself, he did fine. 1 minute after posting the tweet, Left submitted a limit order to sell his shares at $28. This was less than half of his stated price target. By the end of the day, he had sold all of his shares, yielding trading profits of $1.7 million. One thing that's interesting about the indictment is that it never questions any of the substantive information in Citron's research reports. The Department of Justice focuses almost exclusively on the stated price targets and the allegedly misleading statements regarding Left's trading activity. If you're a longtime viewer of this channel, you might be starting to feel deja vu. About a month ago, we covered a different case which shares some striking similarities. A group of social media influencers were charged with securities fraud for an alleged penny stock pump and dump scheme. They released bullish tweets about various penny stocks, causing their followers to buy shares. The influencers would dump their shares almost immediately after making the bullish social media posts. A judge ultimately dismissed the case. While the influencers' alleged actions may have been morally questionable, the judge ruled that they were not illegal. For a discussion of the legal technicalities, you can watch our previous video linked in the description below. But the SparkNotes version is that publishing misleading statements about your price targets and trading intentions is not enough to constitute securities fraud, at least not according to this precedent. Let's say hypothetically that you read Andrew Left's short report about Kronos and decided to short shares of the company as a result. When you shorted shares of Kronos, you knew exactly what you were getting into. Left didn't deceive you about the company itself. The DOJ is only alleging that he misled investors about his own trading intentions. And as we saw in the influencer pump and dump case, this is too far removed from the economic substance of the transaction to constitute securities fraud. Given the similarities with the influencer pump and dump case, there's probably a high chance that Andrew Left's charges will be thrown out as well. I'm honestly surprised that the Department of Justice brought this indictment against Left. The criminal investigation into Left has been ongoing since at least the summer of 2023. The influencer pump and dump case was only thrown out in March of 2024. By this point, the government had likely almost finished their investigation into Left. The prosecution now has a highly relevant legal precedent working against them. Despite this, they move forward with the indictment anyway. Maybe they don't want to waste all of the investigative resources they've already expended on the case. Questions of legality aside, is Andrew Left morally responsible for any wrongdoing? This is obviously a subjective question, but in my opinion, Andrew Left's recent behavior is ethically questionable. Back in the day, Andrew Left used to provide high-quality short-selling research, calling out fraudulent companies. He undoubtedly provided a valuable public service by exposing companies like Valiant. This is how he built his reputation as a shrewd investor. In my opinion, the quality of Citron's research has declined substantially over the past few years, especially since he started exclusively publishing long ideas in 2021. For example, Citron's most recent report was on a penny stock company that is delinquent on filing its financial statements. The share price pumped up massively when Citron released the report, but quickly fell back down. At least in my opinion, it does appear that Andrew Left exploited his reputation to make a quick buck, often at the expense of his followers. Alright guys, that wraps it up for this video. What do you think about Andrew Left? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.